think we are live. Just 1 second. You sure? So I think we'll take it like a free-flowing conversation,
Sure.
and there's enough. Like we have spoken for a while now, so I don't think there is surprises there as such.
Indeed.
Yeah.
Yeah, thank you.
I'll just sort of ask them that if we can go live now. Now you're live. Okay. Hello and a very warm welcome to everybody. I am Shrija Agrawal, and with me is a very meaningful guest today. He is somebody whom I've known for quite some time. I've spoken with him at various occasions, and whenever I've spoken with Anand, something meaningful and insightful has always come out of it. I speak with him for the first time in his new avatar. In my previous interactions with him, he was actually on the LP side, fund of fund side, investing money behind private equity fund managers. And now he's a GP himself. Anand, first of all, it's my sheer pleasure and privilege to welcome you at the MindShift. Uh,
Thank
my,
you, Shrija.
my first question to you, Anand, really that 9+ years of existence at Iron Pillar and a quite distinctive space and niche that you have created for yourself, straddling between private equity and venture, so to speak, right? And really Indian companies building for the world. 9+ years, independent private equity fund manager, from an LP to a GP. If you were to give me the good, bad, and the ugly, what would that really be?
Good stuff. Oh, look, it's an interesting journey, right? And in fact, another 3 more months, and we are going to be crossing 10 years of
Congratulations.
an entire decade of doing this. And the first thing is like looking back, it could not have been better, right? From a opportunity and the real, where India have moved from 2015 when we decided to kind of do this, Monjit, Ashok, me, to where we are today, the journey had been phenomenal because the country's journey also had been phenomenal. So one aspect is, are we lucky from a timing perspective? That is correct. But this is also not specifically from a luck aspect, right? Now, because if you look at growth of different countries, I was in McKinsey before, and then after that, I was part of the team in Sequoia, India, before I went to the LP side and came back to the GP side. What I've seen operating in other markets also is that around $3,000, $4,000 per capita income, countries really like go into a very different trajectory of growth curve. It's due to the fact that consumption increases significantly larger than the GDP growth increase, due to the fact that things like middle class, etc., which you have heard about happening. So we are in the early stage of that growth curve, and we are in the right place to capture that growth curve. So that is actually if you ask about good, right, the good, bad, ugly, that is one aspect. Good, which is a macro, which we kind of predicted, and that's why we betted our 20, 30-year career into this, and that has actually worked out. Because there was a lot of question 10 years back when you're taking that bet, hey, will India get there? India have gotten there, number one. Number two, if you really think about risks of India, and I've seen it from, again, different angles, different sides of the table, one of the biggest risks is liquidity. I don't know, is India going to be able to deliver money back? Is it a place where you put money in and don't see it for a very, very long time or not? So last 4.5 years, that has also changed, because part of this growth is also the other bet which you take is that domestic liquidity will eventually increase. So along with foreign liquidity, domestic liquidity will also drive capital markets, which will drive exits. So $140 billion of capital returned back to private equity and VC investors in the last 4.5 years. With a pretty sensible, there's not one single year which is lumpy. Right? So that is actually another big, great thing which has happened in the market. And the third great thing which has actually happened in the market is the quality of founders. So I remember in 2006-8, early days of Sequoia, it's very difficult to see people, and the same thing for Monjit when he was in DFG, right? To see people dream big. Even building a $10 million revenue company was supposed to be an amazing thing. Having $100 million exit was supposed to be something which is super great, worthy of newspaper headlines. Today, that has actually fundamentally changed to a very different place where founders know that they can actually believe, like we see bootstrap companies at 10 million plus revenue and profitability coming to us there for first raise of capital, right? So that is the quality of entrepreneurs changed along with that market and the liquidity. Now I have to address the bad and the ugly, right? So the bad definitely had been, I think, we as an ecosystem can definitely think about governance in a much more serious manner. I would actually say that, and because that is one thing which just, and again, I'm not saying that this is India specific, right? This is an issue which is there is other similar issues in Europe. I've seen US, I've seen China, I've seen other markets, but it don't mean that problems happen somewhere, so we also have problems, right? We have to actually think about much more hard. So from our perspective, we have seen many situations where we liked the business, went in and did diligence and found something which we cannot stomach and had to walk back from those situations. And we have seen also some situations where founders are not willing to provide full access to information, which becomes a big red flag. So that's a bad. We walk typically away from that, but it don't have to be that way. That's in the bad side. Thankfully, like, look, the ugly side, I don't really have anything because the market is generally doing very well. I would say it is like at expectation or a little bit above expectation in terms of how it has performed. But generally, like, we have been in a good place.
Thanks for that, Anand. So I think it's a sort of a very, very quick and revelation from your end, a very candid one on the good and the bad side. I mean, you spoke about
Yeah.
the opportunities, and I think a lot of work definitely needs to be done on the governance aspect, and rightly so. I think we have had unraveling in the case of Byju's. We saw something happening in the case of Blue Smart. I think this entire sort of thought process that are you too big to fail seems to be really sort of punching us in our faces now. I have to ask you, Anand, that first of all, congratulations on two things. One is finishing a decade for Iron Pillar
Mm.
and a stellar IPO in terms of Bluestone, like the kind of returns
Thank you.
that you've had. What does the Bluestone IPO really mean from an Indian consumer sentiment perspective? I think there were research reports that
Yeah.
loss-making company, perhaps the IPO listing was below the debut price, but then of course they kind of cooked up and now it is listing at a high valuation. So does that really mean that can lift the boats up for all direct to consumer companies, that of course there's some realization that okay, it's the internet startup started with an internet kind of an offering, but wait, they can have a muted kind of an IPO, but then they can sort of recalibrate. Do you think it sort of lifts the boats up for all D2C companies?
Yeah, look, Mohanjit always tell this particular thing. It's a say to do ratio, and Bluestone is actually a company where Gaurav is actually a person who delivers by doing a lot, and he has actually shown it over the period of time. And we're very happy that the public market have actually voted with their money on that. In fact, among the recent IPOs, they are already in 2 months, 2 months and 4 days since the IPO. They are already up 40% in the public market, which is compared to while they did not get a big multiple on a subscription after that. And that's actually the biggest litmus test when a company is taken public. The biggest litmus test from our perspective is how does it trade consistently after going public? Do the public market investors see value? They see the first quarter numbers, which has come out, future quarter numbers will come out, and will they build more confidence over a period of time? In that important measure, they are actually doing very well. Now, coming back to the Bluestone story, few lessons, right? Lesson number one, don't really bother about the pricing of the IPO. And that's something which I always tell. This is just an event. And I know the people bother quite a lot about IPO pricing, etc. And if you are selling a chunk of shares, you should be bothered about it. I understand. But then as a buyer in the public market, you should also worry why a lot of people are actually selling in the IPO. But fundamentally, it's an event which actually opens up an entirely different set of investor base who are pretty much in the size of a company perspective, infinite appetite and risk taking capability, and also in pretty much almost infinite pools of capital to back these businesses and founders. What they have to actually ensure is that, like every partnership, you're going to partner with these public market investors. They have to make money, right? So you have to price your IPOs right rather than price your IPOs at the top. That is one of the biggest things which we actually say. And because this is actually making this change from private companies where there is always this focus on, hey, let's get the maximum price on a private valuation rather than let's get the best investor for the long-term journey, is that's actually what unfortunately translates. So founders have to kind of change this. In case of Bluestone, thankfully, what actually happened is two things. One is like they had investors like Axel to kind of give a shout out to Prashant here, who's actually been the right kind of same voice here, and people like us who said like, look, do focus on building a good business which will be long term profitable, and don't bother about like short term pricing of things. And due to that, they were actually very capital efficiently building the business after the initial phase of e-commerce growth. When they started rolling out last 5 years offline, they were capital efficiently building it. And so they were really not bothered about the pricing, and they were okay to kind of get the right investors for a what we think is actually the right pricing for the market. And that actually worked out
Thanks for
ultimately
that,
for them.
Anand. But I think maybe it worked out the case of Bluestone. But do you think founders are realistic enough and rational enough? Because IPO is a very, very big sort of milestone in the life journey of an entrepreneur. And you want to
Yeah.
maximize returns, you want to cash out. So, this point about pricing that you said, I hope the entrepreneurs are really listening, because this transition from private market to public market, do you think enough
Mm.
hand holding is there? Are they even prepared for public market scrutiny? Because there's an analyst combing through your quarterly numbers now, right? When you are
Yeah.
private, you're private.
Yeah. So I'll make two pretty much controversial statements, maybe, right? One, the best way to build a business is always not taking anybody else's money. And I always ask when founder comes to us to raise money, like, why do you want our money, right? You're already probably running a profitable business, or you can actually take bank loans and make it profitable and keep it private. Like, James Dyson keep Dyson private, right? So stuff like that. That is the number one question. So this is one thing which founders have to actually understand. Obviously, there's a trade-off of growth versus that. That's where they take private capital. Now, when you take private capital, that's the second controversial statement. You do get in a set of partners with you who have a timeline for an exit event. And you have to be very, very clear that their business model is actually not just investing money and helping you grow, but also returning money back to their investors. Unless you're taking money from a family office who say 20 years, I don't care. Right? That's a very different concept. So in that situation, and this is one thing which actually happens, many companies, as or at least Shrija, in the market today, are actually being pushed to going public when they are not ready. And I think this is going to backfire. Some of that is actually have backfired because we have already seen in public market where companies want to continue to do that growth journey, but the public markets want the profitability journey of the company to be also kind of playing out. And then the companies could become, the founders know that the companies could become caught in that middle ground. And that is actually the worst thing a founder want to kind of see his company in, where you have a set of investors or public market investors who want immediate profitability, but long term, you as a founder think that you ought to actually build for the long term value. So if you are building for long-term value, staying private longer is definitely a better idea. Then you are to partner with other kind of investors. There are other long-term, late-stage investors. There are private equity funds, etc. But that ultimately comes down to answer the founder's dilemma here. If you're building in India, one thing which you have to really understand is look at the biggest tech companies in the West, or even China, right? So as an example, some of the biggest tech companies, Google, Microsoft, Amazon, etc., they found one big cash flow mode initially. Similarly, in China, Tencent, Alibaba, Baidu, they all found one business in their core business initially, which actually made money. So that the founders could literally sit in front of public market or private market and say, here's my value. And if you don't give it, I don't want to deal with you. right? And that is very important. So go and figure out, like, really build businesses profitably. Figure out that one area where you can actually build money yourself, so that you can walk into any investor and say, hey, look, I can survive without your money. So I genuinely want a partnership from you rather than just your money. Right? So that is the important thing which founders have to understand. It's a tough journey. It's not easy.
It has to be more than capital. It's capital plus plus. So we spoke
Capital plus plus and
absolutely.
profitability focused.
Yeah, profitability focused. And then we spoke about direct to consumer, the Bluestone story, and how so fabulously it worked out. I think it's a situation that's win-win for investors and the founder. Now let us talk about which is really the talk of the town, and definitely artificial intelligence, where I think there
Mm.
seems to be an AI gold rush, and everybody from uh, every Sam is talking about AI.
Everybody is sad.
Yeah, everybody is Sam now. So every Tom, Sam, and Harry is talking about AI. I wanted to understand from you, Anand, that really, I mean, how does one retain sanity when you're overwhelmed with so much of information out there? And just for like 2 minutes, if you were to compare artificial intelligence to a new country being built, I think
Mm.
the infrastructure, the roads, and the railways have been taken by Microsoft, OpenAI, AWS, or Google of the world, right? Which eventually,
Yeah.
NVIDIA is building the capacity, the power
Mm.
line, the infrastructure. So, what are the low hanging fruits? Are these the cities? Are these the shops which the VCs are after? What really is the opportunity set which is
Yeah.
available for VCs?
Oh, this is a very deep question, but I'll try to kind of unpack within the time frame we have a little bit here, right? So number one, um, from our point of view, like, one of the best things you can do is like catch some of the trends early. So we, for example, we invested in our first AI investment, Uni4, in 2019. So that is one thing. Like, and yesterday they raised money from, interestingly, Nvidia, AMD, etc. They 2.5 billion valuation, great outcome. So one is like, one of the best things to kind of deal with hypes is like be at the place before the hype starts, right? So as somebody said, like, you ought to kind of focus on where the puck is going to be rather than the puck is at this point of time. So that is actually my first point. I think everybody is actually today focused on where the puck is, which is like where AI is today. And my biggest worry is if you really look at technology leapfrogging, and there are significant amount of money and significant amount of interests working against each other. What is the ideal scenario? You have extremely expensive GPUs and an extremely expensive infrastructure, which is actually really being built by very few companies. And like, and ideal scenario, if you really think about Moore's law, etc., is somebody will actually build something 10 times cheaper very fast because there is a clear incentive, economic incentive to build probably AI models which take much less chip capacity for training or completely different pathways. And by the way, there are people who have actually already done it in the world, like DeepSeek have done it. There are a couple of companies now founded in US which are really focusing on, hey, look, the way in which OpenAI, etc., is building the models is extremely resource hungry. The world don't have that resources, and we got to kind of take a much more resource light up, like approach to this, which can now, the downside of this is some of these big companies, whether it is Nvidia, OpenAI, a ton of these guys' value is actually going to be disrupted during that, right? And we won't know. And I think this could, my gut is actually this. And when you talk about this country, this entire infrastructure is actually getting built. Yes, there are people who are building this extremely high expensive infrastructure, very similar to like something like a Broadcom in the internet era. And that was the craze. They were supposed to be that infrastructure of internet. That infrastructure still exists, but Broadcom went burst because their business model was actually not sustainable, right? And I won't be surprised if a similar situation happens because people will figure out a way to kind of do some of that's actually what technology have always done, right? Somebody will go out, some scientist will come out with something which is actually a better, easier way. And there are people who are already proving that. Like a DeepSeek is training their model at 1 by 20 at the cost of OpenAI. And I've used multiple of these models, and I've seen that these models also work as good, if not some cases better. Even though obviously there is also this entire fight between China and the West. So now putting India into this picture, here's my optimistic look out at this. 20% of the AI talent in the world who is actually building these things today sits in India. This is something which people don't talk much about. And there is an opportunity with the right kind of that team to kind of come together. It may include some people who are today working in the US to probably come back, thanks to Trump, hopefully, and and then building some companies which are actually building different pathways to build these models out of a country like India, which can potentially disrupt this entire land grabbing by large companies. But uh, like, don't get me wrong, there is a ton of infrastructure, not only in the chip space or in the model space, but also in physical infrastructure, because this takes energy, this takes many other things, grid capacity, all that, hundreds of billions. Even your biggest private equity funds are now investing a very large amount of money into these areas at this point of time. So there will be a lot of lobbying. This could actually turn out to be something like the pharma playbook, I would say, whether there would be a lot of lobby between these companies, governments of certain countries, which will actually be in hands with these companies, who would actually pressurize other countries to use their product rather than come out with their own solutions. But if India have to be a powerful player in the AI space, we need a different cost structure. The current cost structure of OpenAI, etc., cannot work.
That's very, very well put, and something very profound coming from someone like you. I definitely sort of concur with your view that this kind of cost structure will not work out for an economy like ours. This entire conversation about product development and India being the back room, the engineering sort of room for everybody. But the fact of the matter is that since the time Gen AI has come, a lot of jobs are at stake, especially the low coding jobs. This entire
Mm.
conversation about universal basic income is gaining momentum. I wanted to understand from you that how should one look at generative AI? Is it a friend? Is it an enemy? Or is it a frenemy for an economy like ours?
It's more of a frenemy, right? So I remember 1984 or something, when India had the first computers coming in from IBM. There were strikes, right? People will lose jobs. But like, now we have 40 years of hindsight. We can see that that has actually created way more jobs in the country rather than destroying these things, right? So similarly, like, things like artificial intelligence can do a similar, if the right cost structure and right availability is there. And that's why I made the pharma example, right? So if it is actually available at the right cost structure, and it takes government willingness and founders willingness to kind of do the things, then this can actually really leapfrog many things which we today say. For example, I'll just give a simple example. There is a lot of challenges today on how to get a large part of India properly funded. From, like, people want to start a business, small business. It's still very difficult. Everybody talk about India being underpenetrated in lending. So that is a problem statement, for example, where some of these companies with better qualification of data, better qualification of people, etc., can actually build systems which can probably move the needle from where it is today to 2 or 3x. Right? That's just one example of things. There is so many other things which, a lot of things which the government is doing today can actually be made much more impactful using AI. Like, if you really know, for example, like, there's a lot of welfare spending which still leaks. It is not in the same time where, like, 20 years back, but there is still a lot of leakage. Now, if you really have systems which interconnect and talk to each other, which AI can make it happen very easily, you can actually avoid a lot of that leakage, and you can build much more clarity and ease into the system. So these are some examples where we as a country can leapfrog. So like UPI came and our banking numbers leapfrogged, right? Similarly, AI can help. But on the same time, bunch of people will actually lose jobs. No question about that. But they can actually be um, repurposed. So I'll just give a live example of a friend of mine. He's actually a former classmate of mine. He worked as a senior manager in an IT company, which employ a lot of outsourcing people. And recently I talked to him and he said, like, man, I think I'm going to get laid off. And oh my God, what are you going to do? Because of AI, obviously, right? We are building AI systems and my days are numbered. Well, guess what? I'm actually going to get into commodity trading of some agricultural product producers, because today, like, it's very interesting how positively he said, um, today, like, and he lives in a tier 2 town in India. Today, the people in my people in my community and people whom I know, they are much more aware, and also their willingness to spend on better quality food is actually better, right? Because we have actually, as a country, grown up. So I think there is actually a farm to fork business I can actually do in my city, which would be more fulfilling for me. And I would like to go to the bank and take a loan and probably start this business in the side, so that when I get laid off, I have. So people are very entrepreneurial. India is actually known for being entrepreneurial for, I don't know, thousands of years, right? So I don't think we are to kind of go and solve people's problems. People will solve it in most cases.
But somewhere you think the realization is that your current job, the core job, is not enough. You need to have a plus one, the side gig, especially in the times of where those conversations are gaining more and more momentum as I see it, right?
Yeah, well, that's got to two levels of that, Shrija, because I actually tell something else also. People would be actually living much longer, so you cannot even retire at the same age as your parents. So one have to really think about longevity and its impact on your income, whether it will actually suffice, your pensions will suffice. But second piece is that if you are in a job, unfortunately, where you could be replaced by AI, better start thinking of it rather than worrying about it.
Okay, so Anand, I think I love this conversation, and I think we're talking about a lot of interesting things here. I want to understand from you that we have seen a lot of waves. We've written about it also, and I think at my
Mm,
days, I've spoken with you also in terms of the e-commerce wave. There was a
mm,
crypto wave, and then there was a meta wave, right? The metaverse wave. So much so
mm.
that Facebook had to rebrand itself to Meta. I don't know where is that metaverse gone now. What is to say that AI is going to stay? Because I remember very categorically when the metaverse conversation happened, it almost seemed like that this is it.
Yeah.
Yeah, and I also feel that VCs often give these statements of the new internet, metaverse is the new internet, crypto is this, because they also need new opportunities or new land grabs. Because the plain vanilla internet seems to be like done with. So now AI seems to be the new playground. So I want to understand from you that what really this is.
So look, Charlie Munger says, like, show me the incentive and I'll show you the outcome. Right? So this is a similar situation. So look, if you are in the business of selling coconuts, like, you cannot say that drinking coconut water is bad for you. Like, I'm not saying that coconut water is bad, but you understand the point, right? And if you are in the business of selling sugar, you cannot actually say that sugar is bad for your health. On the same way, if you are actually in the business of selling the next technology hype cycle, Gartner used the same word. They use the word hype cycle. And the latest hype cycle is this. Right? And before this, it was metaverse, and before that, there was like Bitcoin and all that kind of stuff. And so every 2 3 years, we see this. And trust me, this is also going to pass. This is not going to be and most probably the next one which is going to come is probably quantum computing. Because once quantum computing hits us, the hype around that could be probably bigger than the AI hype. Then you would actually see quantum and like biophysics combining together and literally changing. Like, we would see some decade where all of our life expectancy is going to go up by 20 years, right? Because like suddenly machine and man start merging together, right? So these are all the future waves which are going to happen. And each of these waves, people will actually come up and say, this is it, this is the ultimate. If you don't have a piece of this, you are dead, right? That kind of thing. Because that is actually the business model. If you are actually selling the next generation of technology. So ultimately, I come back to that incentive question. So if your incentive is actually, if your business model is actually building the next generation of technology and selling that to a set of investors, then as an investor, you would want to definitely hype that the most. But if your business is actually in making money, and that's something which is very, very important, right? Then you would actually peel that onion one more layer down. And there are two things you can do in that kind of scenario. One is, hey, there is a hype cycle. I'm very good at getting early in that hype cycle, capturing the best executioners of that hype cycle relatively early. I would say it's very important, relatively early in that hype cycle, and then ride that wave. That's actually what an Andreessen Horowitz, etc., do very well, right? And whenever all these cycles happen, they actually the crypto cycle again, like they suddenly started a fund, they funded all the best founders, and made they definitely made sure that they are well positioned to kind of find some of the, if not, and probably nobody can find all, but a good part of great outcomes they have in their portfolio, and you can make money. There is absolutely nothing wrong in that. But the problem in that approach, it is actually there's a beautiful paper which is actually written, which is called "We Found the Enemy and It Is Us." Basically, what that says very clearly is that that way of venture capital, it's just driving the hype cycles. You have to be in probably top 10 performers in that market, or you're irrelevant from a returns perspective, right? And very few people, like literally you can count in your hand, make all the money. And rest of them, if you are part of that game, like, it doesn't really matter. And that's why Silicon Valley also, like the top 10 or maximum 15 VC funds really matter, and everybody else is kind of struggling to exist. But there is another side of that picture, which is actually where whenever a hype cycle comes in, there are a lot of other things which get fallen by the wayside. And that's where, and somebody like us, we find it fascinating. And don't get us wrong, we invest in AI companies. We have 4 AI companies, two of them are doing tremendously well, etc. But we also invest in something like a Bluestone in the other end, because we invested when the vertical e-commerce craze was big in India around 2016, till 2016, and then it fell off a cliff. And there were companies like, Bluestone or Purple or like Nika, etc., which one could have invested and made fund returning outcomes in the 2017, 18, 19 time period. We picked a couple of those kind of outcomes. So that is the other way. You can literally take a diametrically opposite this thing where, hey, look, there is this big hype cycle, but what was the previous or 2 times previous hype cycle? What are the companies which actually survived and did the right thing to cruise through, learned all the tough lessons, and came out in the other side after that cycle burst? Backing them is actually one of the most beautiful things, because you can get them relatively cheap. The founders would have learned all the lessons and they are probably doing all the right thing. That's why they survived. And you have a pretty open playing field to play before anybody come in and throw money at the problem.
That's very, very beautifully put. That if you are in the business of selling the next big idea or selling the next big hype cycle, you cannot be blamed for it. And here is
Yeah.
like you have actually taken the flag high for the VC ecosystem here. That
Yeah,
if
you
you
got to be in top 5 people in that business, or you're pretty much going to be out at some time.
it's a fascinating paper that you spoke about, that Shrija, either you're in top 10, like you just spoke about right now,
Yeah,
or even if you're in the 11, you don't make it to the list. So,
yeah.
what is your biggest challenge being a VC fund manager right now? What is your biggest challenge that on a day-to-day basis that you're encountering?
Yeah. So we are like one of the reasons why we decided when Monjit Mia show started off. I don't know. So look, we understand that early stage, if you want to be relevant, if you want to be genuinely relevant, people can raise cobble some more money and continue to kind of run through. But if you really want to be the best in the game, you got to be running that hype cycles. That's number one. And in India, the biggest challenge in running the hype cycle in early stage is if you're a global fund, you would probably get enough capital. And this is a kind of question about AI also. Many of that running the hype cycles will require a very deep second and third layer market. Say, I'll give an example. If you're a Series A investor and say there is a phenomenal ex Google, you name it, whatever, OpenAI, Indian founders decided to come back to Bangalore and gave you a business plan. Hey, look, I think I'll need $1 billion, but I can actually really build an OpenAI competitor from India. My first check is 100 million that I require. Now, if you're an early stage fund with 400 million, would you put a $50 million check? Literally bet your house on this, knowing that you have no clue whether the next 900 is coming. Versus if you're the same team in Silicon Valley, you know that if these guys deliver, the next 900 will easily come in Silicon Valley, right? So that is actually one fundamental thing. So you got to ride the hype cycles, but the market is unfortunately today not deep. Hopefully it will become deeper over the next decade or something in India, and then that can change. So we decided to kind of decide, like, hey, look, let's be in a very different part of the game cycle, right? So one is 61% of India's economy is domestic consumption. We literally decided to kind of split the world into three and decided that we'll enter companies which have $10 to $25 million in revenue and work very closely with founders and enjoy that journey of taking them to 100 to 200 million revenue and profitable. That's a journey, because that is something where typical VCs or even VC growth guys. So if you're a company which is bootstrapped and 15 million revenue, and you say, hey, I want to grow 40% compounded for the next 7 years, and I just want to raise only $10 million in my entire growth journey, and I'm happy to give you 20% of my company and have you as my long-term partner, but there may not be even a single fundraise from now to IPO of my company. Most VCs will actually run away. And this is actually our opportunity. Like a Bluestone did not raise the price round for 5 years. It's a fund returner for us, right? We love these kind of opportunities because as an investor, you're fully aligned with the founder in building something profitable for long term. So we saw that in the domestic market, both the consumer, direct to consumer, and also what we see as picks and shovel for consumer businesses. Like Servify in our portfolio is a great example, right? You're building systems for insurers to kind of sell. So those kind of companies, you are capturing the domestic consumption story. They're on compounding businesses. They may have been a part of a hype cycle 5 years or 7 years back. Doesn't matter, right? These are things which have actually gone through the beating and come out as gold, and you can back them. So that's where 70% of our money goes into. And then another 1/3 of the money goes into pure enterprise tech plays. Some are SaaS, some are AI, but these are building using India's product development capability, but for global markets. But then we see, you take a Unifor, you take a Fold, you take a Pando. All these guys are founders who have operated in global markets. We have helped them also work very closely with them, and they themselves are capable of moving themselves lock, stock, and barrel to a US company, go for Fortune 50 customers, and really build the India-US arbitrage in this particular case. That's the third case. So we try to kind of stay off the hype cycle and in the growth stage. So while we have been in some companies which are in the hype cycle, we got into the companies before that. We got into D2C before D2C became a thing.
So it's a very private equity approach to VC investing. So it's a VC style of identifying what can grow big, what is the next big thing, but it needs to have the predictability of revenue stream. It needs to have sustainable and predictable revenue. Only then can you think of getting Anand Prasanna on your cap table, right?
Yeah, I would actually peel that onion one more layer more. So there are a lot of companies which are very private equity, like boring, etc. Right? So the way in which our ideal business, which we look at, is like, hey, There is this founding team or a single founder, she or he have an idea in a large market where they have a very unique thing which they understand, which probably the market is today not believing. Like in a Gaurav, for example, came out with something very unique that look, design is what actually people look for. Everybody outsource their manufacturing. I want to perfect doing that in house. Then I can actually deliver this at scale, and then I can become somebody whom nobody can throw money under shit. So something like that, right? Now you have actually a very good compounding business model, but you have a moat because you have a very different way of figuring out that business model is very not very easy for somebody else to come and disrupt. Number one, and number two, you have an almost like infinite or multi-decade runway. That is also very important because like today morning we evaluated three companies. Like we were having our morning call, and three companies came up where we were discussing, and one of them, while the business actually went profitable, the entire reason we decided to pass on it is because we don't see the business being ever being able to build even a $300 million kind of size, like in the next decade, right? So that becomes a challenging thing. So it's not just the private equity like compounding kind of nature, but also having a very long compounding growth story given the space and a different way of them doing something in the business, which give them an edge, which we look for.
So, Anand, let me ask you, how many companies do you say no to before saying yes to a company? How high is your bar in terms of saying no, and how quick is that decision making process?
So we call it 444. So typically we see 400 companies where we meet and spend time with every year as a team, right? And sometimes this number actually go even 500, 550. And out of that, typically in a year, around 40 companies, that is like three or four companies every month, we take them down to the next layer of deeper diligence. And some cases we say, hey, look, like one of the companies today morning, we say, very interesting, but they're still only at like around $4 million of trailing revenue. We want to see them going to $10 million. So it may be another 18 months down the line, they may be really apt for us. So that's a 40, where we are typically tracking these businesses anything from 12 months to sometimes even like recently we invested in a company which we tracked for 7 years. Right? So that is the second stage. And eventually 4 companies out of that. Like in every year we invest in 3 or 4 companies eventually. So it is 444. But the 400 to 40, we typically give an answer like super fast, like within 10 days, typically people would know whether this is interesting or not. And this is, by the way, this is not everybody who's emailing us. Like we probably get like 3,000, 4,000 founders emailing us, right? Now only 400 of them we meet. So 90% of that, we say, hey, look, you're just too early. There's not a space we are interested in, etc. We just give an answer over email within 24 hours. Back on our normally, what we try to do is at least 48 hours. They should get a reply that if it is not interesting, we take a meeting, and the first layer itself, if they drop off, it's a couple of weeks. But if they get to the next layer, it may take a month for them to see whether they are getting to the next level or they're going to be trapped for some time. But even when we track, many times the question which you go back and ask the founders is, hey, what can you actually, like, is there a problem? Is there something which you're trying to solve for today where we can be helpful? So that we are not trying to only get to know them, but they also get to know us on what we can bring to the table.
But you respond to every email.
I try my best.
Wow, that's amazing. And that's
Yeah,
like,
but like, look, I have to tell you that sometimes I don't hit that 48-hour this thing because my email box get flooded. I'm sure the same thing for my partners. And also sometimes people like, somebody from Estonia is emailing me. I don't respond.
yeah. So, Anand, I think I'm loving this conversation. Very, very meaningful. And I'll be towards the end of it. Anand just made a very interesting point about the India consumption story. I'm seeing a swath of Instagram entrepreneurs And I call them Instagram entrepreneurs because I think about 85% of their revenues are being driven by that social media story, that content that they're creating. So essentially, it's content, community, and commerce. I think a lot of these examples are being driven by the success stories of, say, a Mama Earth or a Minimalist, for example. And I think very formidable companies being built. And the Minimalist got sold to Hindustan Unilever. Mama Earth had a public outing. But how do you decipher that how much can only be an Instagram business, and how can some of them can actually be big businesses being sold to a behemoth like a Hindustan Unilever and all of that? Yeah.
Yeah. So this has got multiple layers to this question. But first of all, if you have to be an Instagram success, what you really require, like, again, the two examples that you just mentioned, they all have a hero product, which is, so there are companies which are Instagram only, but when it comes to product, it kind of falls apart. And you would have seen many of that examples. That's not going to work. You need to figure out your social media strategy very well when you know that you have a great product, and probably in some cases, even if you have a business model edge. Because if you have a model where your CAC for social media is not going to drop as you grow, because there is actually an amount of virality which is driven by either what your brand stands for or something like that, or a few hero products or at least one hero product, you're probably down the wrong path, right? That's one aspect of this. So yes, it can be done, but it has to be done well. That playbook is actually, and by the way, this playbook is an ever evolving playbook. This keep on changing, and when I'm saying what would change, the formats will change, right? The online formats, like, things like TikTok was not a thing 5 years back. Now it is actually everything, right? So, and probably I don't know what will be 5 years down the line, what form factors will actually come out. So that is one. Second is when you really build Instagram brands, the problem is it can actually take you up, it can take you down also very fast. And we have seen so many of these examples, right? So you have to be very, very careful, because, and we see unit economics of so many companies in India which are in offline retail. Like, say, for example, one of the companies which we evaluated today morning have three different kind of retail and online model, right? So each of the retail models are actually better contribution margin than the online model, because in online model, and they have two online models, I'm wrong, not one. If you're going through a third party online channel, then you actually have to advertise there. There's a huge cost, that aspect, which is going to kind of eat up into your contribution margin. If you're doing it in their own, like in a company website, everything, then your logistics is actually killing you, right? So you really do see. So kind of figuring out, I am personally, and I would say like even my partners are personally fans of people who have actually figured out the unit economics in the offline market better rather than online market. In fact, when we invested in Bluestone, it was a 100% online company. And if you look at our IC memo, our entire thesis was like, this can build offline, build trust, build brand, and IPO. That was the story. It's just very simple. So that is where the unit economics actually is playing out. And this is just very strange to probably hear from somebody who do a lot of tech investing, etc. It's that it's a boring non-tech offline, which is actually working when it comes about making money.
That is like so much food for thought for Instagram entrepreneurs because you're seeing them mushrooming literally every day.
Yeah.
And somewhere
So
I
I'll give you an example. Sorry
yeah,
to interrupt here.
sure.
This actually kind of comes back to your earlier AI point also. Why is this happening? Because actually advertising in Instagram should not be this costly. Like India today, if imagine the same entrepreneurs had access to another channel in India, which is much more cheaper. It is not the Facebook cost, it's not the Google cost, but it is the India cost structure for like hitting the Indian consumer base at scale. Then the entire story online would have been very different. The problem is your marketing cost is almost like a US cost structure, right? And you have Indian customers. That is where the entire thing breaks down. So coming back to the point, the problem lies in the piping.
That is so beautifully put, and that is the great segue to my next question, Anand, because what we are seeing right now is that most of the businesses that are being built in this country have some linkage to essentially a global behemoth. If you look
Mm.
at consumer companies, they are being built on Instagram. If you look at tech companies, they are using cloud of AWS or Google, some of these large companies. And then there's this entire hue and cry about creating your own WhatsApp, creating your own Facebook. But when Mr. Manmohan Singh liberalized the economy in 1991, the idea was that we are a free economy. We are inviting free capital to the world. Our borders were open. And now, suppose this RTI story has come up in a very big way, challenger to WhatsApp and everything. So, this entire so called protectionism and make in India, which the founders are using very cleverly to their advantage, raising foreign capital to build India own products. I mean, what do you think really is the story going to play out? Because, like you rightly pointed out, if the infrastructure of every new technology or every new big thing is owned by the big tech, right? What really are we really building?
So, look, the number one point which I would actually say is if if you see an elephant and a lion fighting, a lion trying to take down an elephant in African savannah, just think about it. The lion don't go and charge a big elephant head on. Most probably the lion will end up in the elephant's tusk. Right? So elephant is pretty big. And unfortunately, the entire thing, the framing of the question here is actually the problem. And because it is also the most difficult thing, right? I mean, if you are selling to investors who don't understand the country, the easiest thing for them to do is pattern match. And the most stupidest way of pattern matching is, oh, here's Facebook, which I'm familiar with. I'm looking for something which is exactly like Facebook, right? But the real answer is, look, that game is already won. Like somebody have already done it, right? If you're trying to kind of go and do something even remotely similar to that, you're probably going to definitely lose to Facebook. Or if you're trying to build another Instagram, even with some Indian changes inside that, chances are that people like you and me are not going to leave Instagram and join that, or like the young generation, etc. So you got to kind of really think about these problems foundationally 0 to 1. And I'm not saying that there are certain founders who are trying to kind of look at some of these problems foundationally 0 to 1, right? And I'll just give an example of that. One of the largest industries where technology can actually make a big difference is the entire thing about the global pollution. If you think about that as a problem, right? There is, everybody know it's a big problem. India, 43 of the 50 most polluted countries and cities in the world. And we still are actually, many times when we really think about solving problems, we are actually thinking about, oh, there is XYZ have a product. Can we actually get XYZ from Japan or Switzerland, etc., to come in, make in India the same product cheaper? Why don't we really think about having completely different products, like which actually solve our problems in a completely 0 to 1 manner? Just to kind of give an example, I'm not getting into the social media stuff, etc. So this is again a very similar kind of thought process that we are to kind of inculcate, where you're not trying to kind of, if you try to kind of replicate what others have done, you would lose to these guys because they actually are so light years ahead of us in that space. But if you really try to kind of build something from the sideways, like that lion, it actually attacks the elephant from the side or the back when the elephant never knows. And then the lion is on top of the elephant, it breaks its head, and the elephant is down. Right? So that is basically what have to be the approach in taking down these ones.
That is so fascinating, that example, the lion and elephant story. Anand, I think our conversations are only getting more insightful as the years are going by. And I have to end this interview asking what is now next for Iron Pillar? You had a great debut and you said that Shrija, we almost returned the fund through Bluestone, right? So it's been a
Yes.
star portfolio company of yours. So what's really next for Iron Pillar for the next decade? How are you sort of reinventing yourself also?
Yeah, look, this is actually, in fact, next week we have a partner meeting, and like every 6 weeks we get together, and this is the one question which actually takes like half the time when we are together in that 1 week. Um, I think there is a ton to be done in India. Right? That's number one. So if I had to kind of put certain threads, we now have something which we did not have 10 years back, which is like a big pool of founders who have actually made their first set of money, who have actually experienced like the good, bad, and ugly, which you asked initially, right? Who knows what it takes to win in a country like India. So if I ask a few pointers, number one, very few of our investment firms are actually making a very concentrated effort to kind of bring all this knowledge pools, which is actually sitting inside our founding entrepreneurs of our ecosystem, I would say, to the table for the next generation who's going to take the country forward in the next 20, 30 years. Right? So that is actually one from a problem statement. Hey, how can we actually get more of that to our entrepreneurs and the ecosystem in general? Right? That's number one, which we try to kind of. So how do we? 10 years back, we did not have it. Now we have it. How do we actually collaborate more with the most successful founders? Number one. Number two, the ecosystem have actually evolved. And what I've seen, look, one of the biggest landmark moments in the last decade for us is Flipkart's exit to Walmart, because that one event suddenly, like for everybody in the ecosystem, that became, oh my God, this can be actually done. Within a decade, you can build a company and sell it for this kind of size out of India. And multiple millionaires and a couple of billionaires can be created out of that process. So that suddenly gave a different level of energy and so ultimately money going back, right? Really making profits is very, very important for investors, because the most important spindle which really opens the floodgate of innovation and founders and capital and everything to any country or industry or anything is some people going out and saying, you know what, I did this and I made a ton of money. That create that interest for everybody, whether it is a Sachin and Bini building Flipkart and then everybody from IIT want to become them, or like like similar kind of examples, right? When we go back to our investors and tell about our fund returns now, like big institutions in US sit up and listen, and then they say, like, US or anywhere in the world, we have Japanese, Koreans, Europeans, all of them, they say, oh, this is very interesting. Not only I want to back you, I want to back five other people like I in India. Right? So that is actually what we have to kind of deliver. We have to deliver returns. And our founders, investors, and the entire ecosystem think that way. I think we want to kind of do more of that. Okay, we want to really build more real companies in this decade. Last decade, we did a bunch of that. How can we scale this to the next level in terms of, hey, we were doing 4 investments a year. Can we do 6 or 7? Can we partner with more people every year? That's actually what we are thinking about.
That's sort of very, very well put. Thank you so much for that, Anna. That's sort of beautiful closure from your end. I think after sort of really covering this private market, so like more than a decade now, I think the question really remains that the Blackstone of India is still Blackstone in India. Right. So when will we have a PE or VC firm coming out of India being talked in the league of the Blackstone, the Carlyle Group? I think we have enough body of work now. And you rightly put that Flipkart really put us on a global map. And the
Hmm.
swath of engineers who are inspired by the examples of Vinny and Sachin, and there's Flipkart Mafia, PhonePe Mafia, and so many mafias coming out, right? Where entrepreneurs are leaving these companies and starting their own, right?
Hmm.
People working in these companies, right? So I want to understand from you that will the Blackstone of India always remain a Blackstone in India?
I was just looking at my bookshelf. I'm looking at what it takes. The book written by Steve Schwarzman on building Blackstone. So I would actually tell it more in like something like what Steve will say. Right? First of all, Blackstone is built over 40 years. It is not built over 10 or 12 years, right? So, and even today, if you really ask Steve, so go and watch some of his YouTube videos. He talks about a few things. It's grit, persistence, and continuing to compound. Because our business is actually not about running separate, like fad cycles. Our business is actually the Blackstone of India will be created when firms and as a country we together deliver long-term compounding returns for our investors. I genuinely think that we are in the right path. We are actually in a very early stage of a 30, 40, probably even 50-year compounding path. And why I'm saying that also, I'll actually just give you a simple example here. India's per capita GDP here today is actually the same as US per capita GDP in 1959. Okay, both, unlike many other emerging markets where consumption was around 30s at the same point of time, India has 61% GDP per capita of the GDP is actually consumption, and US at that point of time was also in the same place. And India today is compounding at a faster growth than US at that point of time. And this is post-war Europe, US, which is actually already growing fast. So if you really look at these numbers, we have a brighter future than even US. And then you put that with our demographics, where we have a very young population. In fact, our dependency ratio will become one only in 2100. So we have 75 years to compound. And so halfway down that 75-year journey, they would be a Blackstone of India, which could be probably bigger than Blackstone globally. Who knows? And that is actually the journey. But we cannot be impatient about that. That is actually a journey. Also, the aspect about that, again, as I earlier said, it won't look like today's Blackstone because asset management itself will, in that time period, change. And somebody will come and innovate and change that business model.
There's so much to I think we can talk about. We can just continue this conversation for on and on, but unfortunately, we don't have so much
Yes.
time. It's time for rapid fire, the concluding rapid fire. We spoke about
Sure.
opportunities, we spoke about challenges, and what a lovely conversation. Like really taking it from very examples like the elephant, the lion, and how the business models are evolving, the Indian consumption story. So, what is Iron Pillar's anti portfolio?
We don't have that concept, but if you really ask me, a big miss was Nika.
Oh, so you did evaluate Nika, is it?
We did and ended up passing. Big miss.
Okay, great. If you were to talk about two key lessons that you have learned in your journey at Iron Pillar, what would that really be?
One is be more patient with people. Number two is just believe in your original belief always.
Self belief always wins. And my last question to you, if you were to name the most overhyped entrepreneur in the country right now, who would that be?
Oh my God. Do I have to generally do this? Uh, I don't know. Vijay probably, even though he has a public company. There's quite a lot of them.
Okay, I think, but he's like he's a fun guy. He just goes around and talks his mind. I think, yeah.
Yeah. But I think he probably come off that cycle. But at some point of time, I remember talking. Um, Look, again, I'm not blaming him. I don't know. He's actually a great entrepreneur. There is a challenge which every entrepreneur goes through. There is a situation where they'll be facing the SoftBank conversation. Do you want the cannon of money behind you or against you? And the decisions which you take in such kind of situations can haunt you for a decade. And Vijay himself came back and said that IPOing my company was the biggest mistake.
True. But I think it takes a lot for an entrepreneur to come and acknowledge that publicly, also, I guess.
That's true. That's true. I give a lot of kudos to him for that.
And if you were to give full marks to an entrepreneur, maybe it is not from your portfolio, somebody whom you really inspire coming out of India, you think that is an example, what would that really be?
Sridhar Vembu.
Okay. Nice. That's a good pick.
That's one person whom I absolutely admire.
Yeah, it's bootstrapped completely throughout.
Bootstrapped, said no to all the VCs like us, but but build a very, very profitable, beautiful business, which actually focus on fundamentals.
Okay. What book are you reading right now?
Recently, like I'm actually reading Ikigai, interestingly. That is the one in my desk today.
Too late on that one, though. Yeah.
Yeah, I know it's a old, it had been around for a long time, but trust me, I'm actually still catching up with Puranas and Upanishads and everything. So
I see a
quite
distinct
late.
change in you, Anand. From our previous conversations to this Anand, there's a very different version of Anand. Like very,
Okay,
very composed and like you said that being patient with people and things like that. I think you really are out there to build Iron Pill as an institution. And I can clearly
absolutely.
see that coming out of from whatever we discussed right now. I wish you all the best for that, Anand, and thank you so much for joining us on this conversation. We'd love to
Thank
have
you.
more of you and your wisdom and all your advice for our investors, for our founders, and listeners. Till the time we see you next, thank you so much. Goodbye and good luck.
Absolutely.
Thank you.
Thank you, Srija. Thank you for having me. Bye bye.
Bye bye.
Take care.